every lending structure has its advantages and disadvantages. We've always pushed, probably with a little bit of bias, on what we think is the smartest way to do it. But it depends on what you want to be involved in and what your risk tolerance is and how much cash you have available. Private lending offers an alternative financing solution beyond the traditional banks and credit unions, as you guys know, and there's a lot of freedom, which whether it's an MFT, a MIC, or you as a personal private have to make loans. And I think that was one thing that I found interesting to me. Like, if you're not in this space, you just automatically assume there's all these rules and regulations around lending, which there is to an extent, but a lot of those are imposed by the lender.
Yep.
And so this world, there's a lot more flexibility involved in it, which if you're an investor in these, it's good for you to understand what the MIC, the MFT, what they follow, what their structure is, and you should honestly keep an eye on it to make sure that they're following that. Hey everyone, thanks for tuning into the Canadian Private Lenders Podcast, a show covering the private lending industry, the mortgage broker space, and the Canadian economy. Your hosts are Neal Andreino and Ryan MacNeil. Enjoy.
All right, everybody, welcome back. It's episode 72 of the Canadian Private Lenders Podcast with your hosts, Ryan and Neal. Neal, how you making out, man?
Not too bad. Back in the saddle.
Yeah, back in the saddle.
Took about a week or two off there.
Yeah.
But
lots of news.
Yeah, I was just saying, I'm stressed as all hell. I've been on the phone with people every day, just like, what is going on?
People absolutely freaking out, or what?
Well, I mean, everyone knows that I'm very loud in my opinion, and so they call me to get my take, I guess.
Yeah.
And I don't think people are freaking out as much as they should be. I don't know. There's a couple people actually. I'm starting to see it finally. What do I have 73 in front of me here?
Give us your take.
Okay, so there it is. So I've got a couple of different people who have come up that are real estate people, like they're investors, developers, or just agents that are like, what's going on here? Because like we have this tariff thing it's kind of a joke in some sense, but it's not, right? Like, it's just because it just seems like it's been getting pushed around and being utilized for other
tariff
things.
Tariff fatigue is a real thing now.
Tariff fatigue is serious.
Yeah.
The good that's come out of it is Canadians are more united than they've ever been. The bad that I see coming out of it is maybe that it could really throw some of these economies into a tailspin, whether it's Canada or the States, I don't know.
Yep.
But I think I've brought it up on here before, and I've said it to you, and the concept of deflation to me doesn't seem that outlandish as time goes on here. Mm-hmm. And the thing that this is what I've been using AI for the first time ever, is because trying to compare historical events in financial history can be tough, especially because they're obviously not always exactly the same. So I've been trying to take a look at the Great Depression in comparison to today.
Yeah.
And there actually is a fair number of similarities in like the 5 to 6 events that led up to the Great Depression. Now, we don't have World War I, but we had COVID, which was kind of the equivalent in some capacities. Right. And so there was that, and then there was a bunch of money printing. Then there was huge growth in the economy, followed by basically a collapsing of the stock market, followed by tariffs, which ultimately the tariffs were the final piece of the puzzle that just slaughtered the entire economy and made it to the point where nobody could, it was like, yes, things are expensive, but nobody had the ability to spend on it. And now just to circle all that ramble back, the two trains of thought that I'm seeing are like people that are worried that like this economy makes no sense. I don't understand how everything's propped up. Mm-hmm. The other concept that I think a lot of guys in the development space are taking, and the stance that they're taking, is this just means more inflation. More inflation means good for assets. But the underlying problem with that in my head is the inflation can only happen if there's still consumption. And coming out of COVID, there was inflation because there was all this free money coming out. Yeah. Right? It wasn't just lower rates. It was they were literally handing money out. If you had a business, like, what'd they give us? $60,000 and we could write off $40,000. So every small business overnight got like $40,000. Payroll. This was the big one that no one talked about. Payroll injected like billions. Everyone got like, I forget how much it was. Was it 35% or 50% of the payroll?
I don't remember.
It was insane, the incentives.
Yeah.
And there was so many ghost companies. So all this money was flowing into the economy that was that we're not going to get this time around. Like when tariffs get slapped in, I don't see them doing that again because of what happened on the inflation side.
Yeah.
So I just think if you look at the basis of, yes, tariffs could technically lead to more inflation, I don't think the money on the bottom end of it is there to actually drive those prices up. Yeah. Combined with COVID also created like this chip shortage, which I think we also all underestimate how much of a constraint that puts on inventories And all these companies now spent the last 4 years expanding and preparing
Building
for
up
that.
inventory, yeah.
So now they're all way more built up on inventory. So I just don't see how all of this actually leads to inflation. And even if it does, it might make something more expensive. It's not going to come off the shelf. It's not going to be purchased anymore. So anyways, this one I'm freaking out about. This is kind of where my head's going. And I'm trying to figure out what the best play is because nothing feels like a great opportunity right now.
You heard it here first.
Thanks
Neil
for tuning
says
in,
we're
guys.
we're going into the second Great Depression. Confirmed.
I wanted to get it on record, to be honest. I was looking forward to this because I'm like, I want to put this take out there because this way if it hits, I don't seem so insane.
What did we call? What was the name of the Great Recession? Is that what it was in 2008?
Yeah.
Is that what it was? Yeah.
Yeah.
And the Great Depression was like 1929, right?
1939, I think it was. Was it 29? 29 or 39? 29, yeah. But anyways, I don't know
we'll
that
see
it's
if
going to be
history
that bad.
repeats itself. Okay, so before we get into the topic of the day, let's go a little deeper on tariffs here because we haven't updated on this in a little bit, and there's been constant change in this news.
Yeah.
But this publication came out a couple weeks ago now, but about which Canadian cities are most exposed to Trump's tariffs. Okay, and like number one on the list, I think probably shocked a lot of people.
Yeah, I was surprised by this one.
And it's hitting close to home too, right? So I'll quickly go through the list. Maybe I'll go through the top 10 here. So in reverse order, number 10, Lethbridge, Alberta, 15% exposure. Trois-Rivières, Quebec, 19%. Hamilton, Ontario, Saguenay, Quebec, Guelph, Ontario, Brantford, Ontario, all in the 20 to 25% range. Kitchener, Cambridge, Waterloo, up there, number 4 at 43%. Windsor, Ontario, probably not surprising there at 62%. And then 1 and 2. So number 2 is Calgary at 82% exposure. And number 1, close to home here, St. John, New Brunswick at 131% exposure index.
They're overexposed.
I'd say.
They're over leveraged on the States.
I'd say.
All these Ontario ones are all because of manufacturing, right?
100%.
And then Alberta's and New Brunswick is all energy based.
Yes, exactly right.
So, and that just shows
crude
obviously
oil in
Irving's are
St.
just
John,
pumping
natural
everything.
gas in Calgary, obviously driving those top 2 there. And I don't know if the study was done based on a 25% tariff or the fact because it was scaled back to 10% in energy, right? I think.
Yeah, exactly.
Can't keep track, but
What's good about this in some capacity is because we're so heavily based on real estate, it just shows that we're technically shouldn't be as impacted by this.
yeah,
That's one positive.
yeah. One positive. Ontario certainly will be, and you can hear it in Doug Ford's voice. He's fuming at Mr. Trump, but quite interesting. Not only that St. John's at the top of the list, but how big the gap is versus other cities.
That just shows. There's not to be negative on St. John, but there's not
Irving.
It's Irving owns that entire town. Like everyone kind of jokes about it, but it's not a joke.
Yeah.
And it also shows the Irvings have been not super pro Canada. They're just making money and pumping it out here.
The bulk of their business too is like between Maine, back and forth between Maine and New Brunswick. And I know Maine, the governor of Maine said the other day too that they are reliant on Canada.
Mm-hmm.
Right, for their economy to survive, right?
Trump doesn't like the governor of Maine.
No, apparently not. Apparently not. But and that's the other thing too is lumber as well in St. John. So Irving owns all the woodworking and sawmills and everything, all the exports coming out of New Brunswick as well. So that would be a big part of the exposure as well.
Have you seen the clip of Trump with the governor of Maine or the what is it? I think it was the governor of Maine, and he was just like. He's up doing a presentation. He's like, "Where's the governor of Maine at?" Like right in the middle, in front of all the Congress people. And they're like point over, and she's like, "Hey," and she's like, "He's like, you gonna sign that federal order or not?"
It's crazy,
like crazy.
Yeah.
He's like, everyone else has signed it. He's like, if you don't sign it, you're not gonna get much federal funding.
Yeah,
like just
it's a different world.
She's like, "I'll see you in court." He's like, "Oh, I can't wait." And I'm like, "I would."
Oh my god.
Anyways,
it's crazy. It's absolutely crazy.
Yeah.
But yeah. So anyway, so that's kind of the big news here in terms of exposure. Some of the BC markets, Victoria, Nanaimo, Kamloops, and closer to home here, Halifax, are less exposed with more diversified trade partners and lower dependence on U.S. exports. So, but that St. John one does. Is a bit surprising to see at least how high it is, but no more lending in St. John, I guess. Sorry. Just kidding.
Yeah.
Just kidding. We'll get through it.
Oh yeah, but it I didn't realize that. I always would assume it's just Alberta, but New Brunswick is very heavily
quite
tied
interesting, eh? Yeah, and some of the Quebec cities as well. I maybe didn't realize as much, but there's several up there: Lac-Saint-Jean, Trois-Rivières, Drummondville. Aluminum,
also energy exporters.
Aluminum, forestry, and agri-food exports are the big drivers there.
So aluminum is a secondary of energy, basically.
Yeah. And it's interesting. So I just mentioned the BC cities and Halifax, less exposed, and they're more diversified to trade in Asia and Europe. I guess that kind of makes sense, given the port being port cities, right? So another one I was a bit surprised at, and I used to live there a long time ago, was Sudbury, was not as high on the list. Okay. So Sudbury's mining exports, specifically nickel and copper, are the main exports there, are also diversified into international markets beyond the U.S. So
they're very low. Like they're the lowest on the list. Wow.
I would if I had to guess on this list, I would have said like Calgary, and I would have said Sudbury right up there. But where was Sudbury? It was not. It was at the very bottom one on the list, 41, right, of all the cities that were ranked on here. So. Obviously, those minerals and nickel and copper are headed to international markets and likely to Asia. If I had to guess, would be a big player in there as well. So, yeah, but very interesting. But anything else you want to add on the tariff discussion, Neil?
No. Again, I'm just curious to see how it all pans out. I don't love our combative stance, but I mean that's.
Well, and I mean, the latest news is that, the tariffs came in, and then the next day there was a pause on, I think, auto exports for another month. And I feel like Trump's just doing it at this point to because people were pushing back saying, you're not actually going to do it. You're not actually going to do it. You're just going to keep delaying it and keep playing chicken. But he did it.
Yeah. I'm there's the multiple trains of thought of exactly, is it Trump's ego at play here? Is there actual focus on what's better for the countries? Is there, and then there's the conspiracy of the more controlling higher power financial backing that pushes these things around that actually is really doing it, or anyways, I can't figure it out. I'm gonna go hide in a shelter up in the north or something.
Yeah, that's probably a good plan.
Yeah.
All right, let's move in today's topic of the day. So we're gonna talk about the different type of private lending structures. So we've alluded to this a bunch of times in the past, but we're gonna go in a little bit more depth in terms of what the different types are operating in Canada primarily. So of course, there's various structures in place. Each one has its own benefits and risk. And whether you're, borrower, mortgage broker, investor, understanding these structures can help you navigate the private lending space more effectively. Okay. So Neil, do you want to kick us off with syndicate loans?
Yes, I can do syndicate loans. So what is a syndicate loan? A syndicate loan involves multiple private investors pooling their funds together to fund a single mortgage. I'm going to make a little correction to it. It doesn't always have to be private investors, because even the big banks do syndicate loans. Yep. You'll see on really large real estate projects, like the big five, we need to put up $1 billion. They each will take $200 million.
Yep.
So typically structured as a group of investors or financial institutions collectively lending money to one borrower.
Yep.
Each investor or each person involved receives a proportional share of interest payments based on their contribution. Often used in large commercial transactions. Obviously, the benefit associated with that is there's a lot of shared risk and potential for higher returns. The risk associated with that is coordination challenges and also investor disputes. So, the number one reason exactly is shared risk. I know there was a big project here in downtown Halifax. It was $500 million, and they just didn't feel comfortable putting out that kind of money in this city on one project. So they actually condominiumized the project into each section and tried to equal value them. So the parking garage was one, the retail section was one, office section was another, hotel was another. And then they took each a position within those condos to basically help try and mitigate the risk and make it a little easier to get put through. On that note, though, coordination, obviously, there's a lot more involvement there. I'm sure the lawyers and accountants made it like bandits putting that whole paperwork together. But the other, I think, bigger risk associated with it, and you might not see it as much with the FIs, but you'll maybe see it with a private group of investors pulling their money together, is let's say a project gets extended or the dates change or they need more money. If you have 5 investors, they might not all have the same financial capabilities or interests. So they might say, I was only doing this for a year to hold my money here. I had intention for it somewhere else. It's spoken for. Or you might say, oh, like the project now ran over budget. We need another $1 million. That person might not have the extra, their portion or whatever it is to fill that in. So it can be a great way to, I think the biggest part is the shared risk aspect, right? It's a great way to mitigate risk, but it does come with its complexities. But it's very common. I would say this is a big part of loan books, especially on the commercial side.
Yep.
Like a big part of commercial loan books are like this.
Yep. Yeah, absolutely. And just another one that came to mind there too on syndicate loans, like a lot of like the big mix in Canada as well have syndicated loans from the big 5 banks, where it's like it's not just a line of credit from a BMO, but it's like BMO and RBC, you know, working in tandem on that loan, right? Or like 3 different institutions, Scotia or whoever, coming in and splitting the risk on that loan.
So if one person dies, everybody dies.
Exactly. We're going down together. Yeah. All right. Next up is direct private loans, right? So this is where an investor typically registers right on title. So in this structure, a private investor lends money directly to a borrower and registers a mortgage on the property. And now this can be coordinated by a private lender. It can be coordinated by a broker. There's a multitude of situations here that this applies, but that individual private investor or entity would be registered directly on title in this type of loan structure. So the investor actually acts as the lender holding the mortgage on title, like I just said, and often used in like a one-on-one lending relationship type here. So obviously, the benefit of something like this was that there's full control over the loan term and the borrower selection, right? So you're actually be underwriting the loan yourself versus investing into a pooled loan. You actually know the terms of that exact loan. And of course, the other side of that coin is that the risk is that you have a higher exposure to default risk, right? You have to be able to not only do the due diligence, but like know what you're doing, right? Like,
I was going to say that's a win, but also not a win.
Right, exactly. Just because they purchased this property for $300,000, is that property actually worth $300,000, right?
Yeah.
You know, just because this person's got a 700 credit score, is it actually a 700 credit score, or do they have one trade line on their credit and they've, you know, or they've had multiple past bankruptcies that have now fallen off their bureau, right? So
running through a bureau with Zach changed my perspective.
Sure.
He printed one out the other day and was like, look, this is a prime example of one that the average person would say, this looks great.
Yeah.
And then he scrolled through it and he's like, this is bad. This is bad. Here's a mistake. Like, blah, blah, blah. And I was like, oh, wow. So there's
poking
like
holes.
It's not as simple as just going on Equifax and being like, oh, it says 730. This is great.
Totally.
There's definitely
I know,
an art to reading them.
I know a lot of private investors who do look at that and say, oh, 700 plus credit score, easy loan, right? Let's do it. Let's do it. So there's a lot more that goes into it. Okay, so as an example here, let's say, so a real estate investor needs $500,000 to purchase a fixer-upper, okay? Private lender provides the loan, registers a first mortgage on title, and structures the deal with a 1-year term at a 12% interest rate. The lender then has direct recourse on the property in the case of a default.
Again, I mean, I think the people I've met that love this the most are lending to own. Not always.
Some people are good at this.
Some people are good at this, but I've met a lot of guys that are like do a lot of this, and they're either taking a very large rate, or
they're not scared to own. I'd say
they're not scared to own,
right?
Exactly.
Like they're looking at it more so that way, versus in a trust or a MIC corporation. You want to avoid that at all costs because it's a drain on resources.
That's a much better way of putting it. Not to be negative about it, but I just again have met, and to your point, they're not scared to own. And I think if you're doing this, you kind of have to, because the way you have to look at it, and people say it, if you're looking at this, you have to look like you're ready to buy the place.
For sure.
And you have the capability to buy the place.
Yeah, you should always think what's worst case scenario. Yeah, absolutely. Regardless of what structure you're involved in, like what's the worst case scenario?
100%.
Okay.
The next option that we have in here is a MIC, which we are, and that's a mortgage investment corporation. Many of you guys have probably heard us talk about it a bunch of times, but a MIC is a pooled investment fund where investors can contribute their capital, and the MIC will lend out to multiple borrowers. We're governed by Section 130.1 of the Income Tax Act. MICs must distribute 100% of their net income to shareholders. We're RRSP, TFSA, and RESP eligible, so registered accounts can be invested. MICs are required to hold at least 50% of their assets in the form of money or debts secured on residential property. I guess that means we couldn't invest in equities, is what that would be.
Exactly. Yeah, and that's specific. That residential piece is key there. So MICs actually have to hold 50% minimum of their assets on res property, so that can't be on commercially zoned property.
Which may sound weird, but it's well, maybe not, but it's definitely because it's lower risk. And so, the big benefit with this is diversification and consistent returns. And then you also have professionals at the helm of the thing, right? Yep. It's the same concept of like buying a REIT. Like, yes, you might have direct exposure to the real estate, but it's a lot of work and you might not know as much as someone who's spent their career doing this. the risk is you still run portfolio risk. Like there's an opportunity that the big portfolio does take a hit, and everyone knows the news stories of the ones that have had that.
Yep.
And there's also the market fluctuations within the rates, which will get passed on to investors. Because if you remember me saying 100% of the net income goes to shareholders, a MIC is basically selling a product, which is a mortgage, and it is a competitive marketplace. And you'll see this probably more in Ontario, where there's so much competition. They might have to drop rates, which ultimately means the rate of return that you're going to get is also going to go down because 100% of that profit, that net income, is going to you.
Yeah.
So you are exposed to a little bit of market fluctuation on where the rates sit.
Yeah. Still has the same, your costs aren't going to change in that situation. It's still going to require the same amount of
people to run the show.
Exactly. People to run it. So like Neal mentioned, if there's pressure on rates, that's going to likely impact returns in a MIC.
Yeah. We have a interesting example here. I don't know where you would have pulled this, but Keystone MIC.
Never heard of them.
Pools investor capital and funds a mix of first and second mortgages across Atlantic Canada with an average loan to value of 58%. Investors receive monthly dividends in the form of interest payments.
Yep. And MICs are built in all different shapes and sizes, right? So some do quarterly dividends, right?
Yep.
Some are higher LTV and built on second mortgages, right? Like
yep.
we're primarily first mortgages in our portfolio, but they all have their own nuances. We of course prioritize Atlantic Canada. A lot of MICs might be Ontario only, Alberta only. So that's where your due diligence has to come in when you're researching this investment product.
100%.
Yep. Last but not least, we've got MFTs, or mutual fund trusts. Okay, so this is actually quite a similar structure to a MIC,
yep.
but it's structured as a trust rather than a corporation. Okay.
Yep.
It distributes income to unit holders who are taxed at their personal tax rate, so same as a MIC. Mm-hmm. Offers more flexibility in asset location, including lending and equity investments. So you can really...
the main reason.
Exactly. So this really allows you, if your strategy is to have some equity exposure or you're a commercial lender, you can still have this fund structure here, but not have to be governed by those same regulations as a MIC in terms of the residential requirements, okay? So therefore, it's typically used for lenders prioritizing commercial loans. Mm-hmm. And doesn't have any set limits on the commercial versus residential, like I just mentioned. Mm-hmm. Some of the benefits here, very similar to MICs, tax efficiency, depending on how you invest, diversification, of course, and the risks here, of course, there's higher regulatory compliance and variable returns potentially here. I mean, most fund structures, I know we do at least, have a targeted return where you'd be paying that as long as something doesn't go wrong in terms of, pressure on rates or, delinquency or whatever it might be. You're going to target that rate of return, and then you're just going to make an adjustment at year end or quarter end to either top up or, have a slightly lower return depending on how it goes. Okay.
100%.
So just an example here of an MFT. So MFT raises capital from high net worth investors and allocates fund to a mix of mortgages and real estate development projects. One of its investments include a $2 million mezzanine loan for a condo development in Vancouver, right? So this structure here, that typically most MICs wouldn't do that type of investment. Some might, because you can still have up to 50% of your assets, but like a mezz loan on a condo development, that's
liquid.
much, yeah, exactly. That's much more suited towards this mutual fund trust, which is a commercially focused fund.
They're a bit more risk associated. They might have some, also they can allocate bigger chunks of cash, I think, at single periods of time.
Yeah. And the one thing we didn't mention too, so MICs also have a lower requirement for the amount of investors. So MICs, I think, need 25 investors. We should probably know that, but I think it's 20. I believe it's 25 investors. You have a grace period of a year to do that. MFTs require 150 investors, right?
Yeah.
But there's much lower thresholds for, what qualifies as an investment, right? So, for example, Neal Andreino can be an investor. Neal Andreino Holdings can be, and Neal Andreino's RRSP can be another holder for $5,000 or whatever, right?
I wonder if the intention with that was because they knew MFTs are going to be more focused in commercial lending, where like that $2 million mezzanine loan, even though it's got a 12-month term, the likelihood of it paying out in 12 months is almost nil.
Right.
And there's almost a high likelihood that there'll be more money required.
Yeah.
Like if you have a bigger investor pool, the likelihood of the loan,
I'm not sure. It's a good question.
Able to carry itself versus in a smaller pool of investors, it could be in a position where it could really cause things to blow up.
Yeah, that's a great question. We need to have our lawyer Jonathan Lee on because he's an expert in MFTs as well. He built our MIC, so he's on my list to have on as a guest. I think it'd be really interesting to get his perspective into terms of why lenders choose which structure.
Yeah.
I mean, it was a pretty... We still debated back and forth when we were deciding.
You're clear for the first one.
But we were primarily res focused, and it just kind of made sense. The name kind of resonated more, so that's why we went there. But Neal, any final thoughts here before we wrap?
Yeah, I mean, every lending structure has its advantages and disadvantages. We've always pushed, probably with a little bit of bias, on what we think is the smartest way to do it. But it depends on what you want to be involved in and what your risk tolerance is and how much cash you have available. Private lending offers an alternative financing solution beyond the traditional banks and credit unions, as you guys know, and there's a lot of freedom, which whether it's an MFT, a MIC, or you as a personal private have to make loans. And I think that was one thing that I found interesting to me. Like, if you're not in this space, you just automatically assume there's all these rules and regulations around lending, which there is to an extent, but a lot of those are imposed by the lender.
Yep.
And so this world, there's a lot more flexibility involved in it, which if you're an investor in these, it's good for you to understand what the MIC, the MFT, what they follow, what their structure is. And you should honestly keep an eye on it to make sure that they're following that, because if they're stating that they're going to do this and then you get a quarterly report that the numbers are way different than what you expected, that can be a huge concern. Yeah, that, and then I think I have that on your broker, or you have it in here. Brokers and investors should assess their risk tolerance and investment goals when engaging with private lending structures.
Yeah. Yeah. So, and obviously, you want to, consult with your, financial planner to, before you make an investment in any of these types of structures. But, we're always open to discussions on people who want to learn more, whether it's about MICs or any other type of private structure. Happy to have a conversation there. Any other thoughts, Neal, before we wrap today?
No, just tariffs are scaring me.
What else is new?
Yeah, exactly.
All right. Well, thanks everybody for listening. Please do like and subscribe. Give us a 5-star review, and we will catch you next time.
Thanks, guys. Thanks for listening, guys. It's Neal, your co-host and co-founder at Keystone Mortgage Investment Corp. and Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
And your co-host and co-founder of Keystone Mortgage Investment Corporation, Ryan MacNeil. Keystone MIC is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000844, and through FCMB, license 89280. Keep in mind, the views of this podcast are for informational purposes only and are not financial advice.